We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. This is a pre-recording of a Twitter Spaces live event that we hosted. If you'd like to be a part of the next one, go on to Twitter/Palisades Radio, and you can be part of the conversation. You can listen to our conversation on the desktop, but it works better on the mobile app. Just as a reminder, as always, you can find our podcast on Spotify, Apple Podcasts, as well as Odyssey if you don't enjoy using YouTube. I hope you enjoy it and hope to see you on the next one.
We'll take a couple other speakers. Go ahead, Charlie.
Yeah, thank you. Keith, great to hear you speak. And, you know, I've been following the gold market 20 plus years. And I started writing Atlas Pulse in 2012. And one of my main reasons for doing that was because I became very frustrated by the argument at that time of price suppression in what I believe to be a liquid market. You know, gold, according to LBMA data, is $145 billion a day globally. Silver's $15 billion a day. And to throw a spanner in the works, Bitcoin is $40 billion a day. And that might be a month or two out of date since the price has fallen. But nevertheless, I think what's changed in recent times is that Bitcoin has become more liquid than silver. And, you know, these guys all take a different role. Is silver industrial? Yeah, slightly, but who cares? It's basically the gold-silver ratio mean reverts over hundreds of years. And, you know, gold's the killer. Gold's the big boy in the room. Investors have been selling gold for the last year or last 6 months at least. And you kind of got to wonder why. I mean, how stupid can institutional investors be to be reducing gold in an environment like they were seeing? But they've been reducing silver faster. And ironically, if you look at Bitcoin ETF holdings, they really haven't moved them very much in the same comparison, because there isn't the historic accumulation in mainstream accumulation in this kind of new digital thing. Now, I don't want to talk about the Bitcoin thing, but other than that, I think it has caused real competition for silver. And it's one of the explanations of why the gold-silver ratio is so high right now and why silver is dirt cheap gold. But, you know, to Keith's point, I don't believe in price suppression. I think that price manipulation is a real thing. The sell side and the investment banks, they're always trying to clip here and there and manipulate, but that is different from trying to keep the price down. These guys have been dumping gold, and these investors have been dumping gold because the trend's against them. So they get basically trend followers. Who's been buying? The central banks. The global central banks have been accumulating massively over the last few. In fact, they've been accumulating every quarter since 2009. The only quarter they sold, they were net negative, was Q3 2020, when ironically was max investor accumulation. So the central banks are smart. They underpin the gold market, and that is a very powerful force. And that's why the volatility of gold is so incredibly low. I don't want to go on. There are other people there, but I just want to say thanks, Keith. Great words. I don't believe that the gold market's manipulated from a suppression point of view, but of course, every market is manipulated from a sell side trader tick point of view.
Charlie, great to hear your voice as well. I may be in London in a month or so, I'll reach out to you and try to hook up there.
Yeah, I think you're around.
Thanks, Charlie. That was really well said. It's, you know, that difference of what we're talking about is very important to understand. O'Hare, go ahead, man. You've been waiting patiently.
All right. Hey, guys. Fantastic discussion. It's about time we get a room like this, Palisades. We need more of these. We need more education for people out there. And I love what Keith was saying. I love what I don't know if Jim's still in here. I love what Jim was saying. Their discussion back and forth. I just got home, took a long walk in the sun. I'm in California. We've been having a lot of sun, so I'm trying to get as much of this sun as I can. I love what Charlie was saying. This is all fantastic. I love to listen to you guys. And I agree with a lot of what you guys are saying. There are some disagreements, but by and large, I agree with pretty much everything you guys are talking about. It's not, in my mind, it's not so much this, when people talk about gold and silver manipulation, the price manipulation, it's not so much in my mind. And we've done a lot of work. My partner and I run a small mid-cap value strategy. We have about nearly 20% of our strategy in precious metals, gold mining, silver mining stocks. We're big believers long-term in this particular asset class. So we've done a lot of work over the last 12 years since the inception of our strategy in this particular space. We've talked to a lot of operators. We've talked to a lot of academics. We've talked to a lot of traders. Just you name it. And kind of what I come away with is when people talk about price manipulation, when the average person on the street, when you're listening to these things and like the trial that the traders you guys were talking about, the JP Morgan and Credit Suisse and UBS and some of the other and Citibank, some of these guys, when you talk about when this information gets released, people think, oh my God, it's the price is getting suppressed. It should be keep us saying 50,000. I mean, I've had discussions on Spaces over the last few months with people. The price is going to be what the price is going to be. Now, as far as manipulation, I mean, it's in my mind, it's not so much like pure manipulation, meaning suppressing the price artificially by financial mechanisms. It's more subdued. It's more nefarious than that. And what I mean by that is, it's if the general public in a country like the United
I just got to say, guys, I got to bail, but it's been great, and let's do this again.
For sure, Keith. Absolutely.
Thanks so much for your time, Keith.
All right, thank you. Take care.
It's not so much like it's not suppression by by mechanics. It's more suppression in my mind by the fact that the price they're not allowing the price, the gold price, the silver price is not allowed to float freely, and therefore it doesn't take too much. I mean, you guys are talking about volumes. When you compare volumes for silver and gold to, like, for instance, the bond market or the equity market, it's a fly in it's a tiny gnat. It's not even comparable. And so there's really no interest on the part of individual investors until you get that price momentum. Until the price starts to move, people get excited. This is why, for instance, Bitcoin has taken kind of the front seat in terms of interest as a way to kind of hedge that fiat currency and the inflation aspect of it away from gold and silver. Right? Because people have seen the price move so much, they get excited. People get excited when the price moves, and that's what people buy. They're not really looking at gold and silver because, quite frankly, it's just kind of just been sitting there, right? I'm excited personally because I think the fact that gold and silver are where they are, given that the Fed has been raising interest rates for the better part of this year, significantly, not a little bit, significant interest rate increases. The fact that the dollar has strengthened to 40-year highs, multi-decade highs, and yet the price of gold is where it is, tells me everything I need to know about which direction you want to position yourself in terms of gold and silver. And I think that direction is much higher. So like Keith was saying, 50,000. Look, you could pick any number you want. You could say 100,000, you can say 30,000, you can say 20,000. It just doesn't really matter. I look at it this way: if the price of digital ether, right, a digital number on a screen on your phone or on a computer, something that's intangible, doesn't exist other than in your mind, Bitcoin, if that price is $20,000 or today 18 and change, it's been dropping, people are losing faith in it, right? The price moves with momentum. If price is moving up, momentum begets buying, and buying begets buying, and it moves up. The other, conversely, if the price is moving down, people start to lose faith. So my point is only that if something like that, like something that doesn't really exist, but it exists only in the minds of its buyers, can go to $65,000 US, then anybody that says gold can't go to, somebody that says gold is going to 50, to me makes total sense. Now, to a lot of people, it's hearsay. To a lot of people are like, oh my God, that guy's an idiot. Gold's never going to go to 50,000. Those same people would agree that Bitcoin could go to $1 million, right? So, the reality is, I think over time, people will, the general public is waking up. I think we're having this epiphany. We're having it certainly in energy. I spend a lot of time on energy. We have about 20% of our strategy in energy, a little over now. Commodities in general, things that exist in the real world, things that every economy needs, The world looks much different today than it did 20 years ago. The US is losing momentum in terms of its global power, its global stance. I mean, we're still number one, but we're certainly not the number one we used to be. And we're, really kind of doing the wrong things, to stay number one in terms of the way the world looks at us. I mean, so, to me, it's this, the suppression thing you guys are talking about. It's fantastic. I love the discussion because in my mind, it's not like somebody's out there nefariously, like there's meetings behind closed doors that the New York Fed say we got to keep the price of gold at sub 2000, right? I just don't buy it. I don't think that's going on. I think it's almost like, it's like this. Hey, we know where we need to keep gold. We know where we need to keep silver. We know where, we need to keep the dollar. We want dollar to be king. And so it goes without saying that the guys that are actively trading in these markets, gold and silver, primarily it's institutions. These are not retail investors by and large. They're kind of just tossing this potato back and forth and the price doesn't change too much, right? So I think once people wake up, once the average investor, the Americans, the Europeans, once people start to believe that they need something other than a paper currency, right? I'm not saying the US dollar is going away. I'm not saying the euro is going away, although that certainly could happen. Germany could go back to the Deutschmark. I actually have talked about that in the recent past, and we wrote about it actually a few years ago in our quarterly market commentary. But, the reality is I think people are starting to wake up. Gold, silver, I think, personally, I believe, and I think you guys do too, it's here to, it's going to be here. It's been here for thousands of years. It's going to continue to be here. It's something that I think people are going to discover once again. And when they do, the price is going to go a lot higher. The mining stocks are going to do a lot better. I think it's going to be in conjunction with, it's not going to replace certainly paper money, but it could act as an anchor to some extent. So anyway, I love these discussions, Palisades. You guys need to do more of these. I love hearing from guys like Keith and Jim. I love their banter back and forth and what Charlie was saying. I think it's more people. We need more people in these rooms. I mean, I don't know how many people are in here listening to you guys, 400 now, but I mean, there are rooms out there with, 2,000-3,000 people, 5,000 people listening to rooms on NFTs and cryptos and the end of the world, these bear rooms. I mean, it's just crazy. These people need to be in these types of rooms where you can get educated on what is really going on in our society and how to prepare, how to position yourself.
Thanks, O'Hare. And, it's kind of funny as August obviously has drawn to a close. It's nice to get some energy and some eyes back into the metal space because August, as I've been doing this for a little while now, and August, it just seems everybody drops out. Nobody wants to talk about gold or commodities or anything. And it's to be.
And I would just too, the spread. Everybody talks about the spread. The spreads, you can't really look at the spread in gold and silver and say, well, the spread's really narrow, so the market's healthy. Wide spreads indicate unhealthy markets, but narrow spreads indicate everything's good. I don't look at it that way in terms of gold and silver. I think I believe that when you do inevitably have what I would call a run on gold and silver, in other words, massive amounts of people starting to call their investment professionals asking for an allocation to gold and silver, when that happens, and I believe truly that it will, that spread's going to widen a lot. Because right now, the only participants in there are just these institutions moving this hot potato back and forth. It's really, they make of it what they will. They want to keep a pretty tight spread. The spread will widen, and that would not be an indication to me that it's something wrong. It'll be an indication to me that once those spreads start to widen, that's a good sign. That means that there's a lot of people interested in the same thing, and these institutions now are going to be, having to me, that's a sign we're looking for. That's not a bad thing. That's going to be a good thing.
Mm-hmm. Absolutely. Does anybody else want to have?
I have a unique perspective on this. If you can hear me, at least one that I don't know that anybody's talking about. So a little bit of background. I worked for the largest U.S. solar manufacturer for solar, and so I've seen the growth of solar firsthand. And one of the things that I saw working there was just the brutality of the Chinese in terms of the competition, the competitive aspect of it. I think about 90% of the solar technology is manufactured in China. And if you obviously know anything about solar, at least the Chinese technology, there's obviously a big component of that is the need for silver within their panels to produce electricity. And while many bulls on solar point at being a sign of bullishness on the price of the actual silver, one of the things that I've been concerned about, and I think we've seen play out this year, is really the economics of the solar panel kind of get blown out of the water if certain things change. The thing that changed this year is, if anybody's following the polysilicon market, which is another big component within the Chinese-made solar panel, the price of polysilicon has skyrocketed 400% price of that component into the manufacturing of the solar panel. So when we talk about rigging of the markets, and I agree, I do think there's huge manipulation that occurs within the metal markets. I think a lot of the decline this year within silver has been a direct result of needing to bring the cost of that component down to make up for the gap that polysilicon price skyrocketed has caused within the economics of Chinese-made solar. So I guess, where I sit in terms of, I'm very bullish on metals in terms of, I think the fundamental price of silver is significantly higher than wherever it is trading today. But at the same time, I think about obviously our wanting to move towards a sustainable future, both here in the US and globally. And, thinking about, will they ever let the underlying price of silver trade to where it truly probably deserves to be? That's my perspective, and I'm happy to hear what everybody thinks about that view.
Shall I go ahead?
Yeah, that was a great bit of perspective on the components that go into the solar panels. Who wanted to speak?
Yes, thank you for hosting the space, first of all. Great space. Just before putting a point which I think was raised earlier, I was going to address a couple of points mentioned by one of the speakers earlier. Respectfully, I'll disagree with a couple of points raised, in the sense that when the spread is narrow, that's a sign of a liquid market. When it widens, that's a sign of volatility or a liquid market. So essentially, if you want volatility, maybe the widespread is an indication of that, but you don't want to be trading that spread at the same time. So you might want volatility for other reasons, whether it's for options trading or whatever. But you don't want a widespread if you're going to be trading the spread. So you want narrow spreads, but usually narrow spreads are a sign that the market is liquid and you've got lots of flow of bids and offers. Anyway, that was one point. The other point was I think he mentioned without mentioning the bank that's been in the news lately. The price doesn't necessarily move. They don't necessarily move the price. Well, the price does move on a temporary basis, but it reverts back after they've taken their profits. So it's not whether they move the price or not, it's whose profit they're taking, the profits that would have been the profits of other traders. They're illegally capturing profits that weren't going to be theirs had they not used those methods. Now, you and I could have traded that same market in a similar manner. If you remember the flash trader, that kid trading from his bedroom in London, he was more or less doing the same thing. But then the CFTC called him in and asked him everything about what he was doing, and they learned the process from him. And on that basis, we thought that that sort of activity was going to stop.
We've been kind of addressing this whole manipulation thing. There's a million different ways to look at it. A lot of intricacies to understand about it. I think we've kind of beaten it to death here for today. Bob Coleman recently did a big silver presentation at the Silver Symposium again this year, and he was going to give us kind of the Cole's notes on it because it was really well received. So Bob, if you're ready to kind of present that, I'd love to hear about it.
Yeah, I appreciate you having me on. Yeah, a lot to go over in terms of the manipulation theme. I guess it was something I actually had brought in, sponsored Matthew Hunter, who used to head the CFTC Enforcement Division, and we did a presentation in the evening last week over this topic and so forth. And I put together some slides and gave a presentation as well. It's the tough thing about manipulation is the intent that to not only profit and gain, but to artificially suppress the price. And obviously with trading, there's a lot of different activities that go on during the day that they don't pertain to manipulation. They just pertain to normal everyday activity. And I put some charts in the nest. Let me just try and go to it real quick. One of the charts that I did, I think it's the third chart or so. But basically, this one it's one that's paraded around on FinTwit and the internet a lot. It basically takes the intraday prices. If you chart the New York close, if you bought it at the New York close and you sold it at the New York open, if you bought it at the New York open and you sold it at the New York close, but this is the silver price in terms of relative percentage change of value terms. And then they have just a continuous silver price. And it shows a huge discrepancy if you bought basically at the New York open and you sold at the New York close every single day for 50 years. What people need to understand a little bit is that the New York market, it's the center of the financial system. So for the longest time, that's where a lot of the activity was taking place. A lot of the hedging that was going on was taking place. A lot of the speculative and futures actions, a lot of the arbitrage. So basically every day, even if the price went up in Asia or in Europe in the middle of the night, typically when CFOs and trading desks of mining companies and other fabricators, users, refiners that would normally come in and hedge production, for example, they would simply come in, go when it's most liquid during the day and put on hedges, for example. And so you see this activity that looks like manipulation over a period of time, but in essence, it's just simply the way the markets are. It's just that's where the liquidity is. A mining executive in Canada, for example, is not going to wake up at 3 a.m. and start selling futures contracts to hedge his production. He's just going to wait till he wakes up in the morning and then call a trading desk and make that trade. So some of these are just simple nuances of it. It's not necessarily the manipulation. The part of the problem and that's where some of this discrepancy comes in. Part of the issue to understand the physical silver gold market versus the institutional market, institutions for the most part don't give a crap about physical metal. They're not in it for the physical. They're in it to make profits off of spreads, off of arbitrage, off of creating product, institutional product, derivatives. That's where the money's made for them. To them, the metals are just simply a tool. To understand that, if you look at one of the slides that I put in there, which was an example, I think it's the last slide in that nest. If people just understood, if they looked at the precious metals, the investor or the normal person, they understood that physical metals are private property, just a simple concept of private property, and that what we're headed into, I think, is a worry over social policy, political policy, tax policy, estate planning, numerous types of potential monetary controls that we've seen. The inflation, the theme that central banks can create inflation at will, can create money supply at will, expand the balance sheet at will, and then the sort of the confidence effect for when something starts to break. If the investor sees the physical metals as property rather than money, the money argument is a difficult one for most people to grasp. But that's partly why the physical metals, I think, hasn't really taken off to the mainstream public, because everyone thinks of a credit card as money or cash or obviously with crypto now, a lot of people think that's money. So, but to private property and the metals as bearer form, you don't need to have the thing confirmed by 1,000 nodes or whatever it may be, or you don't have to have someone else's promise to pay. You can give that coin to your neighbor to mow your lawn or whatever it may be. That's a powerful idea, and that's something that the industry needs to really capitalize on and educate people with, because there's very few other assets that lack any type of counterparty risk out there. They're all reliant on other counterparties. One of the themes that I talk about a lot is the creation of all these products, ETFs, ETPs, ETNs, derivatives, buffered notes, callable buffered notes, all these types of things that are created by institutions to get participation maybe in the price of the metals, or to show that they have exposure on the commodity side, but they have it in a security or paper form, just because that's what their charter shows. I put an example up here, the DB Silver Fund, for example, the Invesco DB Silver Fund. And you see the word silver and you go, oh, that's a silver fund. So, and I see this in a lot of the supply demand charts. I think Metals Focus and some of the other ones out there that list Invesco in the demand side, investment demand side. And what people don't understand is that this fund designed to capture yield through U.S. Treasury or government securities, and then expand that leverage into silver futures to capture the price action of the metals. So basically with this, there's not 1 ounce of physical metal in that fund. In fact, it has absolutely nothing to do with actual physical metal. It's just a representation of the price of the metal. And this thing garners, $100 million plus in assets. I mean, if this is what Wall Street has created, this is what sponsors have created, is this world of, you could call it sponges that are soaking up potential assets that may have gone to the physical metal, but it's going into securities and other types of assets that replicate the performance of the metal. And that's what we tend to fight more in our world, is that representation of the products and how that impacts the price. I put in here another chart, for example. Let's see, this is I think the second one in the nest. This is one that I did where it basically shows the 2008 debacle and how silver went from like 19 to $9 when Lehman Brothers went down. And it shows that physical market has very little to do with the price action. It's really dominated by the paper markets or futures markets. So for example, in this chart, silver went down hard in price, but yet during that year, 43 million ounces were accumulated during that same time frame. And in fact, actually, when the price really dropped, the physical fund actually net increased in value over the few month period. But yet on the same time, instead of 43 million ounces added to SLV, there were 500 million ounces of paper metal sold on the COMEX, which destroyed the price. I mean, you could say it was liquidation in terms of margin. It could be a number of different things, but that's what dominates the price, is the paper market. And what I've tried to strive and educate is to help institutions, high net worth individuals, and so forth, to say, listen, if you buy the physical and you take delivery, you're reducing the leverage in the system, at least from the standpoint of maybe the registered category, the metals that are on receipt against the futures contracts, the ability to have an unlimited amount of contracts that can be created. You start to pull that metal out of the system, and that starts to turn eyeballs. That's how you make change. The way I see it in the markets is reducing that or deleveraging. And in fact, actually, the funny thing is Basel III was something I wrote an article about when everyone thought that was going to force prices to the moon. I was saying, no, actually what's happening is the banks are deleveraging and they're backing away from the fractional or unallocated programs that they have on their balance sheet, where they'd have an unallocated gold program, for example. And basically what that meant was someone could buy an ounce gold, but really in essence, that gold is represented by the balance sheet of the bank, not necessarily an asset that they have in their vault, versus an allocated type of program. And so what Basel III basically started to put onto the banks was this degree of, if you're going to put on those types of programs, you're going to be penalized in terms of you're going to have to raise capital to support the leverage for that program. So it disincentivized the banks to continue the unallocated programs. And what basically sent the activity, I guess, clearing parties from, so instead of trading with the bank, for example, you're going to be trading through the bank as them acting as sort of like a clearing firm, but the action would be sent to the exchanges. So it relegated the risk of the exchange and away from the bank's balance sheet with these unallocated types of programs. And obviously you saw fiasco with nickel and so forth. And those things can certainly happen, but it's putting that risk on a regulated market versus, an OTC market. And so there is a degree of deleveraging that's happening in the system. To get into a little bit about the structure of the market and why the metals are acting like crap right now. What's happening is the funds and CTAs are using a playbook which is probably the same thing that they followed for 40 years. Every time the Fed raises rates, liquidity starts to tighten. And I should say the Fed's actually pulling. It's not them raising rates. Them raising rates is sort of a fallacy. They're actually behind the curve. They're just simply that's them. The illusion of them actually controlling interest rates, but they don't really do that. It's actually the market and it's the balance sheet of the Fed. And there's a lot of integral structures with demand and supply of U.S. Treasuries and so forth. That's into a totally different discussion. But the playbook is simply, okay, liquidity's tighten up. We're going to start shorting and selling commodities because they'll tend to get whacked in a recessionary type of time frame, or because of liquidity just simply tightening up. So basically the game plan has been short commodities and try and capture that secular trend. So if you look at the first chart in that nest, basically shows that in July of this year, this is in terms of aggregates, total dollar value, we were the second highest short. If you add all the four metals together and you look at the short interest, you have to go back to 2018 to see the level of short activity that was going on in July. In 2018, we put in a relatively very firm bond in the precious metals markets. And what's happening is we're seeing a dislocation with all this futures selling or paper selling, for example. And some of this is also, some of the derivative products that were created, the buffering of the buffered notes and so forth, giving downside protection, adding to adding to the pressure of the market because it's protecting the downside for an institution that's investing in the silver market. For example, these buffered notes may actually invest in SLV, not really silver, but some of these programs will actually provide, say, the first 20% of the downside of the market. They offer protection, so it's sort of a incentive for institutions to buy that product. But to get back to it, what's happening with this pushing of prices down is it's forcing these backwardations, which I started to notice back in June of this year. All four metals were going into backwardation, which is it happens. But what started to take place was the backwardation was extending out and was not just simply 1 or 2 days. It was not just 1 or 2 weeks. It's now, you're going on 3 months with some of the metals, the white metals specifically. Gold simply went out of backwardation when the September contract, or we rolled to the December contract. I'm sorry. That's when we went out of backwardation with gold. But when I'm talking about backwardation, just to give a little bit of an idea, I'm looking at the lead month contract, not necessarily the near term contract, but the lead month contract, and not necessarily the entire curve. Even though platinum, there has been times here where platinum's entire forward curve is in backwardation to the spot price. What that's telling me is lease rates have been going up, and they're exceptionally high right now, and it's starting to impact financing costs. And one of the reasons you're seeing a lot of metal leave the COMEX, for example, on the gold side, is you're seeing funds that were maybe leasing the metal from a refiner or from a bullion bank, placing it on the COMEX and playing the arbitrage or the roll. Well, that lease rate's gone up so much that it now disincentivizes them to hold that gold and try to play that arbitrage anymore. So they're now canceling the lease at this point, returning the metal back to the refiner and so forth. So you see a lot of that going on. You see on the silver side, a lot of metal that's coming off the COMEX is metal that's designated to fabricators. It's not coming back on the COMEX. Once it goes, the process is it leaves the registered category, goes to the eligible, and the eligible typically loads out and goes to wherever it's going to be used to make product. But the market has been tight enough where literally refiners And also mining activity has been a little bit slower in the summertime, which is seasonal, and so sourcing of metal has become a little bit more difficult, especially going into the way it was in August. And so you have refiners that are literally pulling metal off the COMEX to make product. Literally some of these are shipping it all the way to Switzerland to make product. So this idea that there's a million ounces above ground and the metal will come onto the market at any time, and if that was the case, if someone could explain to me why lease rates are going up and backwardation has been so extensive, I would love to hear the argument, because you typically don't see, you would normally, it's one of the reasons why precious metals typically don't go into backwardation, because there is a lot of metal above ground, but it's not coming to market. It's staying in people's hands, especially now that we broke down in silver prices. Now if you're not selling in the 20s, you're probably not going to sell in the teens.
That's kind of just the argument that I was trying to make with this thesis that I have around the solar market. So if you think about all the solar projects, right, they've been contracted for the next 3 years in terms of what's to be constructed. So they need solar panels. The price has already been negotiated. And then what happens? You have the price of polysilicon, which is a huge input cost to 90% of all the solar panels that are made, go up over 400%. So, oh shit, now we need to figure out how do we get our cost in line to make the economics for all these projects that need to be contracted, fulfilled, built, constructed in the next 3 years. Well, we got to bash down the silver price. So what did they do? They bashed down the silver price down to $18. And I bet you every manufacturer hopefully has hedged for the next 5 years at I think I saw $20 was where futures were like 4 or 5 years out right now.
Is there any way to hedge their costs on the polysilicon?
No. At least not that I know of, because I mean they're literally, from reports and stories that I've read, they were using potentially forced labor to be able to manufacture at a really low price this polysilicon. I mean, you just like it's in the news. Go look. So I mean, this is my theory on why prices of silver have fallen this year. I guess the question that I have in my mind, and I'm a huge bull in terms of, I believe the price of silver should be significantly higher, is why are they going to ever let it trade higher? If they need this commodity, which is a rare commodity for this new green revolution that we're trying to move towards, why is it ever going to change? And that's obviously something that I wrestle with is, I believe the price of silver should be significantly higher, but I guess that kind of maybe begs the question of, does Chinese-made solar actually work in terms of the technology long-term if the input costs can't be kept low?
Yeah, there's also, I mean, you touch on a good point with the manufacturing side. I mean, look at platinum. There was an article that came out, I think it was last week, talking about some of the European refiners are going to have a really difficult time making platinum product because they're missing. It's getting really tight to get a certain ingredient, a chemical ingredient, in the process of making that platinum. There was some talk whether it was hydrochloric acid or ammonia, and ammonia would be maybe because it's in short supply due to fertilizers, but some of the simplest things, you look at the energy problems and natural gas, these are all things that are going to affect the supply side of product for physical metals. Silver is obviously 70% of it is industrial, but these are fundamental constraints.
But I guess what I'm trying to say is, and I don't know the end products that well for silver, but what end product couldn't take a $100 plus silver price? I mean, $30,000 automobile that wouldn't even be around in terms of its input costs. But when you're talking about a Chinese-made solar panel that they're trying to manufacture for a little over $100, $150, the impact that change in the silver price would have has, enormous consequences to the economics of that end product. And that's really where, I don't think silver should be at $18 or $20. I think it should be significantly higher. But at the same time, this future that everyone's trying to move towards, which is this green future, but can the economics of solar, at least Chinese-made solar, work at a $100 silver price? I don't think so. But again, that's obviously what a lot of the silver bulls point to as being a significant demand for the commodity. Yet at the same time, I don't know that it can be a demand for the commodity if it can't support from an economic standpoint. So that's something that I
was just, by the way, just to your point there, I just wanted to hop in and I just actually Googled to see what it was, because I was curious myself what amount of silver actually goes into the average solar panel. Because again, silver is the most reflective material we have, and it's the most conductive metal we have on Earth. And so it makes sense if you're going to be using solar panels and batteries, to move electrons around, you want to use the most the metal that's the most conductive, right? To use as much of it, so that latency is not as much of an issue. 20 grams of silver in an average solar panel. I'm not sure what size that is; it doesn't show, but that's on JM Bullion's website. 20 grams is 0.643 troy ounces of silver per panel. Now, they're probably talking about a panel that goes on your roof. So, call it 4 feet by 3 feet or whatever they are. So 20 grams per panel. So I'm not sure what those panels, you said they're like $100 or something US for Chinese made panels, but
they're trying to get them down to like 140.
Yeah. So, I mean, it's negligible. It's obviously, I mean,
it's
$100. It would have an impact, but
well, that's where a lot of myself included, I think, what is the, natural occurrence of silver to gold, and in the market, it's like 8 to 1. So, I mean, you could conceivably have multiple $100 price for silver, and
you're talking about gold to silver. Now, if you're talking about silver to copper, it's like $1 million. I mean, it's just not even close. So
no, and
I was in a spaces earlier in the week. There was a topic was copper. And some of these, some of these rare earth metals and copper and the shortages thereof. And, one of the speakers was talking about the use of copper and why aren't we using silver or gold? And I chimed in. I'm saying, just imagine if you were to use silver instead of copper in your home. How many miles of copper wire are you running in an average automobile or in a home? You know what I mean? It's like you couldn't do it.
I should point out. So I think I mentioned I worked for the U.S. solar manufacturer named First Solar. And there's a lot of unique aspects about their technology that are different from the Chinese make. Does not have any silver and also does not have any copper in its panels. They specifically removed copper a few years ago. Right. So because they were so scared of where prices for metals could go, and I guess sort of where I have a significant exposure to metals investments, and I believe they're very undervalued.
I would just say this, just in a nutshell. 50 years ago, 60 years ago, 100 years ago, we didn't have solar panels. Okay, 1,000 years ago, we did. 150 years ago, we didn't have electricity. So the reality is, gold and silver will again, in my opinion, be used for what they've always been used for, which is a safe haven, an asset you can put in your pocket, put in your safe, hold on to for a long period of time to keep up with the cost of prices, inflation, right? The cost of doing business in the real world. And so, everybody I hear this a lot. Like I loved what Bob was saying, because I hear this a lot. Like everybody's like, oh, silver's, the price is down because of the industrial application. 70% of it's industrial. I get it. But 150, 200 years ago, 500 years ago, 1,000 years ago, silver was money. It's always been money. It will always be money. Now, it's just in the last 60, 70 years, right? It's literally within the lifetime of your grandparents. The society has changed. It's not been forever. I mean, it's literally been I'm 47 years old. So like, for instance, my grandparents, their lifetime, like many of your grandparents, so this hasn't really been, this experiment, this fiat over and over and over for hundreds of years, and it's never worked. It will never work. And so I think focusing on I'll just finish here. Focusing on the industrial applications for gold and silver, that's just the icing on the cake. In my mind, the qualities of gold, the qualities of silver as a metal, that's just the icing on the cake. Used in what? Medicine, high-tech electronics, medical equipment, military applications, satellites, things like that.
That's where I'm trying to understand, and maybe I don't understand it enough, but I understand one aspect of the market for end uses of silver well, which is the solar market. And I guess let's say that silver became, money again and resumed its trend and probably went to significantly higher. Could these end markets change to another material, live with a silver price that's significantly higher, or is this industrial metal so important within the world that it will be beaten down by every central?
Let me answer that question. That's a great question. Let me answer this way. If you think about silver, just silver, and you think about what silver has been used for the last 150 years, it's primarily been used for film in the photography industry. That's it. That was where most of the silver was used outside of investment. Okay. But it just doesn't happen. Now, it's still used in photography for high-end pictures like wedding photos, reproductions, things like that. But by and large, it's not used in photography anymore, right? It's just a niche business now. And so, it used to be used for photography. Now technology's changed. Now we have digital photography, right? So to answer that, in a way, that hopefully answers your question. Solar panels. What other applications are we going to be using other than maybe using silver, right? Or in batteries or in other things? I mean, human beings will always, we're very good at developing new technologies, finding new ways of doing things if resources are scarce, right? Finding new ways to do things, finding cheaper way to do things. It's called productivity. So absolutely we'll have things that replace silver. There's no question in my mind. What's not going to replace silver and gold, right, is more fiat printing, more fiat currency, more IOUs. That's the difference, I think.
I guess, from my perspective, so I don't think I made the argument, well, the economics of solar can't work with a triple-digit silver price. I think that's 100% accurate. I mean, anybody can run those numbers. I do think silver is going to go to that price because that's where I believe, the natural laws of supply demand indicate that it should be at. And I also think that what's going to happen, like you said, is innovation is going to happen. And I think there's desperately needed innovation around solar to be able to consume a significant lesser quantity of it. I think it can support it as an industrial metal, but also support its true fundamental market price, which I believe is significantly higher.
I would say that the outlier that moves the silver price, and if you just want to look at price, it's always been investment demand, because that's been the change at the margin that's had the biggest effect. So, and not to get off topic here, but I think the last 2 years, ever since the COVID thing, the response and the precious metals market became alive, I think the industry dropped the ball big time by allowing themselves to get greedy and literally profiteer off the consumer who is buying the metals on this idea that, hey, listen, I got to protect my purchasing power, or this, political policy, or whatever it may be, systemic risk. That brought a lot of people to this market the last 2 years for the first time, just totally take advantage of. Premiums went through the roof. That people started to see the premiums start to recede a little bit, especially on the bid side. And now that they paid $8 over spot for a 100-ounce bar back when it was at 28. Now that literally the price has to go up 50% or 100% just to break even. That weighs on people's psyche. And I've talked to a lot of high net worth individuals that got caught up in sort of that emotional moment the last 2 years. And basically the industry was dealers or even the wholesalers were literally like the Venus flytrap. That has done a lot of damage to the accumulation from an investment side of using the physical metals as a store of value. You need the industry really needs to get back to a level where they can make money at doing this, but they don't make an obscene amount of money. I mean, it was absolutely crazy. The stuff
Yeah, and I agree with you. And I think it was, obviously, in my opinion, it was a direct result of many billions of solar power plants that had already been contracted over the next 3 years to use Chinese-made modules, which hadn't been manufactured yet. That when the price of polysilicon, and you can go look it up, skyrocketed from like 11, I forget what it's quoted in, but essentially like 11 cents to 45 cents a kilogram. That blew the economics of all of the solar manufacturing in China, that they had to the one commodity down that could bring those economics back in line. That is my view on the conspiracy of it.
But even with the cure for that is simply over time, if energy prices continue to rise over time, that would actually justify maybe the need to use solar at whatever cost, because it still maybe is a alternative to paying 250% growth in your monthly electricity bill, especially if you're living in Europe.
I guess I'm a huge proponent, obviously, of solar. I think there's, the utility of it is enormous, and especially what we're seeing in Europe. I guess in Europe's case, unfortunately, their whole economy is based around natural gas. So, I'd love to put solar on my roof if I was in Germany, but if my gas stove can only cook with gas, I'm kind of shit out of luck. So that's really, I think what Russia knew is they can't off of this gas problem and go to solar, because their heating, their cooking, all of it's based around natural gas. Now, I think this trend that we're going to see is a continued move towards solar. And I guess what I'm saying is, unless we rapidly innovate in the solar marketplace, I do think the price of silver is going to skyrocket, and it's going to blow the ability to manufacture at a cost profile that's competitive with obviously other sources of electricity. So
let me just ask you guys this. We're talking about uses of something like, for instance, silver used in solar panel applications, among other things, and that use is going to grow exponentially for the next 50 to 100 years. I have no doubt about that. Let me ask you something in reverse. The use of catalytic converters in cars. In the state of California, for instance, they're phasing these things out over the next 20 years, right? They're the next 15 years. In Europe, they're doing the same. So, no question that over the next 10, 20 years, 25 years, 30 years, you're going to have fewer and fewer cars with ICE engines. You're going to have more powered vehicles. Now, what's going to happen to the price of platinum, right? Platinum is used in catalytic converters. Platinum is a rare earth metal. Okay, it's more expensive than gold. It's more pure than gold. It has similar qualities to gold. So should we just imagine for a second, you think the price of platinum is just going to go to nothing? It's just going to drop by 90% because all of a sudden the main use of platinum, which is catalytic converters, is going going away in the next 20 years. So this is an interesting topic because, I agree with Bob. It's really difficult to kind of wrap your head around that. You have two uses. You have monetary uses for these metals, investment uses, and then you have these industrial uses. And so while some metals like silver, for instance, are going to have applications, other metals like platinum are going to have fewer applications, or maybe, so.
I guess what I would say, what I would say to that, price of lead, lead, the primary end use is lead acid battery percent of batteries, lead acid batteries recycled, yet the price of lead still has gone up quadruple since the 80s. So, it's been a better performer than silver. So can you make the argument that the primary end use of that went away?
Well, and that's a great point. And that's a great point. And the reason I think that's a great point is if you think about lead to silver, for instance, why don't they want to suppress the price of lead? Because it doesn't matter. It's not a monetary metal. No one's going to put that in fact, it's
exactly
toxic. So, whereas the qualities of silver are actually non-toxic, right? They're antimicrobial. So actually, there are some valuable, things with that silver is used for that other metals are not. Microbacterial properties that are used in medicine, for instance. So going back to that nefarious argument of there's something going on, somebody's suppressing, the central banks are suppressing the powers that be, right? These guys wanting to control the world, they want to control the price of gold and silver and, keep it down. We don't want to be excited about gold and silver. I mean, look, I just think like Bob was talking about like the bid-ask spread earlier and about the mechanics of how that might, how that might work, and the fact that you have all these ETNs and ETFs and all these different like financial instruments that mimic the price of the underlying commodity like gold or silver. For every one of these ETFs, there's an inverse ETF that's been introduced now. So you kind of cancel those things out. So really, Bob is right in the sense that a lot of these paper instruments, they really have nothing to do with the underlying value of the commodity. It's really just straight up gambling on the price of the underlying. Unless you own this commodity, I know Sprott's got one. There's several that are, GLD, for instance, SLV, for instance. But again, if we have a catastrophic calamity in the financial markets again, is GLD and SLV, are those companies sponsoring those ETFs going to be able to deliver? And that's the question, right? At the end of the day, they settle in dollars.
Well,
so that's really the problem.
It's worse than that, because GLD, every share, and this blew my mind when I read this, but every single share that's in a brokerage account is basically the legal owner of that is Seed and Company. It's the
That's right.
LP
That's right.
LP of DTC, or was it DTC?
All they owe you is the price. That's all they owe you.
Right. So that's the issue of systemic risk. For people to put their money in the ETFs, what you're really doing is you want representation of price, and you want to track the price. That's all you want to do. And that's what Wall Street has basically capitalized on. They've created an entire, basically has become a sponge that's basically soaked up money that otherwise would have went to physical metals. And my whole argument for the last few years, and this is why I opened up a depository. It's one of the largest private depositories in the country. I run a hedge fund that's physical metals. I realize this type of system can't go on if started to wise it up and said, listen, I'm just going to buy physical. And the problem is the industry just destroyed the image of precious metals, because the people that did wake up and said, I want to buy physical, were charged out the butt for it. And now they're starting to realize, God, I paid $2 over spot for 1,000-ounce silver bar, when I could go down, you could buy it on the COMEX, or, you go through the process of taking delivery on the COMEX, or you could, there's more efficient means to buy physical product. It shouldn't be as expensive as it is. And that's been a detractor. And that's something the industry can correct itself on. But that's really what'll move the price when the supplies really tighten up. And physical people don't look at the market, or physical investors don't look at the market the next 6 minutes or 6 weeks. They look at it over the next 6 years. They really worry about multitudes of different things. Like I mentioned earlier, political policy, tax, all that kind of stuff. That's just a small portion of why they buy the physical metals. Yeah. Or they're just they may never sell it. They may just hand it to their heirs. Of course, the heirs will get it and sell it in 5 seconds, but that's another story.
One thing I always find fascinating, Bob, is, and Gnostic's got his hand up, so we'll go to him in a sec. But one thing I've always found fascinating going into these spaces, and specifically these crypto spaces. And this is exactly why I go into these crypto spaces. I've spent literally hours upon hours over the last year listening to these people talking about, crypto, and not just Bitcoin, just the whole Bitcoin, ecosystem, right? The whole crypto ecosystem, but specific to Bitcoin, which is their messiah. The argument for people in the Bitcoin space, like the Michael Saylors of the world, is that it's the blockchain and it's crypto and it's changing. It's going to revolutionize the world. It's digital gold. They really truly believe it's digital gold, and this is the argument. And I always find it fascinating, because in some ways I do agree. Give you an example. You live in Hong Kong. You have family in Beijing or Shanghai. You're a wealthy individual. You want to move a bunch of assets out of Shanghai into Hong Kong, so then you can move that to New York or to London, right? And how do you do that? Well, you do that via a very careful maneuvering of cryptocurrencies, right? It's very easy for these guys to go out and open a wallet and move some money into this and that, and then move it around. Now, there's slippage, right? There's going to be, you may put say 100 million worth of Bitcoin on a wallet, and then 3 weeks later only get 90 million out, right? That goes with the territory. So the argument for these guys has always been and always will be like it's fungible. It's very easy to transact it. This is why they always bring up countries like Congo and these like developing market, emerging market countries, and these dictatorships. North Korea, China, in many ways Russia, where these cryptocurrencies are widely kind of used for mainly just kind of nefarious reasons, right? To move large blocks of money around. Now, here's my point. You could do the same thing with gold. The argument for them is you can't move a ton of gold. Like if I'm worth $100 million, I can't move $100 million of the gold. But see, that's nonsense. It's the value of the underlying that really is the critical aspect here. For if gold were $50,000, it's 50. Okay. Now, as crazy as that sounds, Bitcoin was, $100 a few years ago. Now it's $18,000. Wrap your head around that for a second. Bitcoin, a key entry, on a computer, literally nothing, thin air, ether, as they call it, right? Similar. My point is, if the price of gold were, say, $50,000 an ounce, 14.58 troy ounces equals a pound of gold. Your shoes weigh a pound. $29,000 of gold at $50,000 an ounce. Okay. So my point is only that, this argument that, you can't move large amounts of wealth, you can't keep it away from authorities because, at $2,000 and $1,800 an ounce, you'd have a truckload of it. You can't do it. Yes, I agree, but at $50,000 an ounce or at $100,000 an ounce, and some people are calling for Bitcoin to go to $1 million. Imagine gold at $200,000, $300,000 per ounce someday because everybody on the planet has 10% in gold, in silver. I can imagine that. People can imagine $1 million Bitcoin. I can imagine, a multi, six-figure price for gold. Why is that so hard to imagine? If that were the case, it wouldn't take too much gold for people to kind of put that away and move it around. I mean, that's the thing. So when you look at it from that perspective, the price, not the quantity. If the price is low, obviously I need a truckload if I'm a rich guy. If the price is really high, like Bitcoin, I don't need a lot. Now with Bitcoin, it's just, you put it in your pocket on a USB drive, but with gold, prices are a lot higher, multiples higher than it is now. Same kind of situation. I could put a pound or two or three into luggage or whatever, hide it. I could I'm not saying you're going to move it across borders because then you got airplanes and everything else involved in airports and seaports and things like that. But for example, for savings, as a savings vehicle, people say, well, you couldn't put it in a safe because you need a ton of it. Well, that's not true. If gold were $50, $60, $80, $100,000 an ounce for the average American, you could put a few $1 million away in gold. If let's say you were worth $20, $30 million. So the argument for me, anyway, I don't know about for you guys. Maybe give me your view on this, Bob. But it's a function of the price of the underlying, not the quantity of the underlying, right? Those are two inverse things.
I appreciate your input there, O'Hare. Let's get to Nostik because he's had his hand up for quite a while here.
Oh, that's okay. O'Hare knows me and he knows I'll be patient.
Yes, he's a very patient guy. Yes,
we all kind of have to be patient on these spaces if we want them to be civil.
Yep. They do know me, so they know I'll be patient. And if I can wait without getting interrupted, you don't really have to move the physical commodity around. Have you ever heard of sheepskins? So
they use it, don't they use them for? Oh no, that's sheep intestines.
Yes, they use multiple use product there. It's also supposed to be quite, non-hypoallergenic. Anyway, and O'Hare, you always do this to me. You break me up laughing, and I end up chuckling. Oh, that's fine. I got to have a laugh for the day. Sometimes it's a bad day. Anyway, the sheepskin. If you go way back, one of the things that they used was basically particularly signed and stamped sheepskins as ownership for gold. So those became the substitute for carrying gold around, and someone could sign and transfer them, sort of like a check to somebody else. And this became the way that traders used before they had coins or before they had the rest of the stuff and some fancy trading things going back and forth. But anyway, I'll go quiet for a minute because I'd like to address my question to Bob if he comes back.
Now, we had another, Jim was in here, somebody was in here earlier, and they were talking about the spreads, and like the narrow spread. I don't think it was.
Yeah, that was me. That was me.
I actually wanted to answer your point, and because I think you were addressing it to me, and I completely agree with you. in normal markets, right? A very narrow spread. A healthy market has a very narrow spread, very narrow. Okay. Now stocks, very liquid stocks, trade at fractions of a penny spread. I mean, they're very fluid, very liquid. The wider the spread, the more perceived risk, the more illiquid the instrument. So gold over right now, I've been very, the spreads have been very, kind of tight. They're not very wide, which, and for very good reason, right? Because there's just not that many market participants. If you think about how large the actual market is for trading of gold and silver and who's involved in that market, it stands to reason that there aren't that many people. The spread's going to be pretty narrow. It's one bank, one central bank, one commercial bank, one large industrial producer. I mean, there's really not that many players when you think about it on a global scale. Where it gets interesting is if all of a sudden, imagine tens of millions. I'm just using America as an example because the market, people have investment accounts, IRAs, taxable accounts. Many people are well versed on saving money for retirement, that type of thing. So just imagine for a moment if even 25% of Americans, I'm not talking about everybody, just a quarter of the population decided to allocate, say, 5 to 10% of their savings into gold and silver. That would change the dynamics for this market in a big way in short order. And that's where you're going to see that spread, and it's probably going to widen a lot. It's going to scare people. But this is what we're looking for. When that spread widens, that means that the demand for the product, the demand for the gold and the silver is much, much higher than what the market can stand. And the price will move in accordance. So to me, that's
the spread sometimes widens also when there's major volatility in the market. Say there's a major announcement
that's correct.
That's due.
That's correct.
So if there's a major announcement that's due, or the Fed is going to release figures, etc. Some market makers, when they're not spoofing, that is.
Sure.
What they do is they widen the spread because they don't want to be caught out on either side of a trade when the price is about to fly one way or another.
The spoofing thing, it's come up a lot on these spaces. We talked about it a lot here. One of the things about I'm getting a lot of feedback there, Sugar. There you go. One of the things about this spoofing, this is not somebody may have pointed this out earlier when I got bumped, but this has been going on forever. Spoofing is not like a new phenomenon. Certainly not new in gold and silver or commodities, and certainly not new in stocks. I mean, this happens in stock markets all the time. Okay, and the fixed income markets. I mean, I remember back in the mid 2000s, like call it 2003, 2004, 2005, when Millennium, for instance, and a lot of these quantitative AQR and a lot of these quantitative managers, hedge funds out there started trading started getting into the kind of the high frequency trading. A lot of times they would spoof markets. They spoof it millions of times, within minutes. I mean, literally all kinds of different markets just to feel. It's almost like, how do I explain this? It's almost like, when you're watching like a sea urchin, you all have all the little tentacles, and each tentacle kind of comes out and then comes back in, comes out, comes back in, feeling its environment as it's moving along the seafloor. Same thing with these quantitative strategies, right? They're just feeling out the market. And they're sending out these bids and offers to this is the spoofing. It's what it is. This happens all the time.
Yeah. O'Hare, part of what actually happened in that is when electronic trading and they allowed through SIAC, they allowed people to connect directly, and you were able to sit down and put your bids in directly, and they allowed third party people to sit down and do it
right next to the exchange. Yeah.
Well, sure. No, everybody had to connect through SIAC, so all data went through SIAC, and the thing is that if you co-locate real close to it, you can sit down and do this stuff. This is before the high-speed trading. Now you had Island come in, you had Arca come in, you had a bunch of other electronic exchanges come in. They didn't have the liquidity to sit down and attract anything away from the floor of the exchange. What they decided to do was sit down and say, we've got to show some depth here. So they actually paid for those so-called spoof trades. They actually paid anywhere from a quarter of a penny to half a penny for each bid and each ask within that area. So they actually paid to
for
have
the
it
order
there.
flow. That's correct.
They paid for the order. Well, no. They paid the order flow is different than the trade. So the trade order flow They were buying order flow from other places. Previous to what they were actually doing is buying what appeared to be liquidity by paying for bids and asks that would show up on the screens that would attract more business that would then attract the order flow. So they didn't care if what you put in was executed or not. They just wanted to show that there was stuff there so people would be attracted to their market on a narrower spread than it would be on other ones. Now, the idea of the people who were doing that was not to sit down and actually make money on the trade. They were actually getting paid by the exchanges to sit down and do that. And the fortunes that were made for that, there's guys living in Maui retired years ago and still collected an ongoing extreme stream of money for a long time without profiting from any of the trades. They were just supplying the appearance of depth into the marketplace. The order flow purchasing came later on, and the high frequency trading came later on to that. And then eventually somebody yelled and screamed and said, hey, this is spoofing and it's illegal. You're creating a false market, which was really rather hilarious. And those of us who actually did some of this were sitting down, killing ourselves, laughing, going, wait a second. The very people that literally begged on their knees to have it done so they could get their market up and sell the entire market into NYSE or into the market, literally begged to have people do that and supply that information. We're now screaming, this is illegal.
Yeah.
It was just hilarious.
By the way, in the late 90s, and I remember we had an exchange meeting one day in 1998, I think summer of 98, right after the Russian contagion. They had a meeting that the SIBO was actually going to acquire the PICOs, and because of all listings for the West Coast tech stock that were listed, the options that were listed there. And when I started on the floor, it was all fractions, right? The stocks and options were traded in fractions. And then what you had was called decimalization. So you went from having 16ths, eighths, quarters, halves from fractions to decimals. So when that happened in the late 90s, that changed the game for everything. I mean, that's really when all those exchanges you're talking about really kind of blossomed, because you can imagine at a 16th of a dollar, you couldn't be running those types of strategies. 16th of a penny, you could run them all day long.
Oh yeah, but it just knocked them right out. Anyway, right. Sugar, you wanted to put something in.
Yes, please. Essentially, what the guys at the bank were doing and where they fell foul is they were texting each other, and more or less that came to light. So it was an admission of guilt. However, I think you were touching on one of the key points that I actually wanted to mention, which was essentially the algorithms can do that non-stop, and a lot of them are Black's type algorithms where the the CFTC is unable to actually go in and see what those algorithms are doing. They're essentially spoofing, but it's in the form of an algorithm, and sometimes some of the spoofing you can't actually tell whether it's spoofing or it's, I cancelled the trade because the price moved and therefore I no longer wanted to sell or buy. Some of it's happening high frequency, some of it's not. But in many cases,
you're completely right. You're completely right in one aspect of it.
It's like the chicken. It's like the chicken or the egg, right? The chicken or the egg.
If I could interject here, the CFTC, and I had a great discussion with Matthew Hunter at the Silver Symposium with this. The CFTC actually has data. They can see a lot of stuff that goes on. They can pull a lot of records. They can do records requests and so forth if there's a legitimate investigations going on. The problem that the CFTC has is manpower. Matthew was mentioning that he had some of 80 staff members under his reign when he was looking at the markets the last 10 years. Well, that staffing that examines market data and so forth is now down to 16. They don't have enough people to oversee all the markets that are going on. You're talking millions of different contracts out there, whether it's options and futures and swaps and forwards, everything in the realm of trading, OTC products and so forth. They don't deal with the cash market. They don't deal with the physical market, delivery within 28 days and so forth. Everything outside of that is their purview, and they just don't have the manpower to search for all this stuff. And it takes a couple of years to develop an actual case that they can actually bring to court with, because they really they can see all the trades, and they can they can eventually they can also break down the trade and determine the intent of the trader as he was placing those trades and how the market looked to them when they were placing those trades as well. It's the markets have just gotten huge. And it's impossible to keep track of this stuff. That's one of the issues. That's one of the reasons why it's very frustrating that this stuff goes on and on and on for years before it's actually.
Bob, in order, you're right. You're right. But think about it this way. You're right. They are undermanned, but they're not only undermanned. They're they don't have the technology that Renaissance or some of these firms have. I mean, these firms spend literally tens of millions, hundreds of millions, and billions of dollars on technology to run algos to decipher exactly what's going on in the market. I mean, there's so many trades, so many of these things being put in every second that, I mean, can you imagine being an accountant for the CFTC and getting a box of data for like a day's worth of trading dropped on your desk and said, we want to know what happened here? I mean, literally, it would take you years of manual labor to go through it. It would take, I mean, it's literally that complicated. I mean, so to develop. And by the way, the guys that are doing this, they know this. They know it would be very difficult for the government to come in and say, "Look, doing something that's wrong, and we know you're doing it wrong, and for these reasons." To prove a case would be absolutely just insanely difficult.
Let me get my question into Bob before I get bumped off here. Bob, the question I was going to pose to you, the hypothesis I was going to propose to you was, what if gold and silver are in fact, excluding North America, worldwide looked at as an alternate currency, and as such worldwide traded independent of the US dollar? And then when US trading started, because it is traded in US dollars, gets reflected in US dollars, and suddenly it moves. I've been tracking it for a long time, and I watch it virtually every day, minute to minute. And what I see virtually every day is US dollar up, gold, silver down. Manipulation? No, it's a direct reflection of some other currency valuation. So as soon as I put in other currencies, gold is going up in those other currencies because the US dollar is going up. So it's a reflection of a worldwide currency relative to the US dollar. And so the variations in it are quite dramatic. Now, those variations take some fluctuations, like as soon as Tokyo or New Zealand, Australia start trading, there's some really wonky pricing in there, which really shows the difference between the lack, like you were saying, the trading in North America has its own supremacy, so to speak. As soon as that's not there, and you go to like Australia, Tokyo, Hong Kong, US dollar can fall or rise dramatically, and the price of gold and silver responds accordingly just for a little while. And there's a trading opportunity in there, which we take advantage of sometimes, but it's quite a swing. And then you go back as the larger markets open, and it trades not in direct reflection to the US dollar so much as in direct reflection of the currency in which it's trading at the moment. And then as soon as the US market opens up, everything readjusts back to the US currency. And I see this virtually every day, every single solitary day when we sit down and watch it. When people sit down and say it's manipulated or it's done this or it's done this, I think you have to take all of the classifications for how gold is traded as an international currency, independent of the US dollar. In one sense, it's just acting as any other international currency would relative to the US dollar. Then you've got the manufacturers, you've got the savings people, you've got all the rest of the people who want to sit down and do it. Now, I've got alarms set on my system that if this ratio doesn't happen, if gold and silver move independent of the US dollar, or in this case, rise or fall more than the dollar, so the ratio changes, then all of a sudden, like, the alarms go off and we go down and take a peek. It happens every once in a while when there's some exogenous form or exogenous issue that happens outside of the US, and people collect it and see it in the US later on. And then slowly you watch it readjust. So it lasts for about a day, and then it disappears and goes back to a US dollar reflection. I've been watching this for years, and it's quite standard. I'm waiting for that to break, which means as soon as gold and silver relative to the US dollar, independently of the US, like, they just start rising within US dollar valuations or international currency valuations, that's what I'm waiting for, to sit down and watch gold and silver start to take off. But what I'm not seeing is, I'm still seeing, like, the dollar is, I think, 110 today, and gold and silver were down. I haven't had a chance to look at it on the screen, but that's what it was earlier yesterday, I think. So if it's actually used as an international currency, And as the dollar goes up, gold and silver go down internationally, but stay stable in the relative currencies in which it's trading or people are dealing with. You've got multiple things going on. So I track yen, euro, ruble, and renminbi against gold price and sit down and look at it. And it's a pretty stable pricing ratio, which makes me think that internationally it's looked at as an international currency or international savings mechanism. Gold has gone up quite dramatically in other currencies, just not in the US dollar. So the regionalism of this is a massive effect on US gold and silver, US price gold and silver. I don't think it's as manipulated as people think, although I have come to conclude that, watching it very closely, there is some sort of element of manipulation going on, just haven't been able to sit down and classify exactly what it would be. And some of the things you were talking about earlier, I find quite fascinating, and I'll have to go and dig in a little bit more into that. But what do you think of that thesis for gold and silver acting as it does?
Yeah, there's a lot to unwrap there. It was interesting. Last week when Jeff Christian did a great presentation on the silver market and the trading of silver, he provided basically a couple of different examples of 3 and 4 hour windows of silver trading in 2021 in January, the lead up to the so-called silver squeeze. And he looked at basically in this 4 hour market day, you had an enormous amount of volume. And so he was making the case that, hey, listen, on one given day, there could be an enormous amount of volume and the price goes down. And then on a day, you can have an enormous amount of volume and the price goes up, which is great. I mean, but what I saw in that was that in that 4 hour window, you had a third of the entire world's production of silver trade in that 3 hour window. And in another example, you had 550 million ounces of paper metal trade in a 4 hour window. That's the magnitude that dominates the price action in the metals. I mean, the precious metals, you have to remember, there's every time an ounce is pulled out with silver, for example, it's typically as it goes through its product life, leaves the gate and it goes to the refiner or the smelter, whatever it may be, and it starts to be made into product and refined down. It's being hedged at some point or sold, and potentially the futures, if they use, for example, the COMEX, for example, that 1 ounce of silver could be sold 5 different times in terms of futures contracts, hedging that as it flows from to the miner, to the refiner, to the wholesaler, to the dealer, to the money manager, or to the retail investor, whatever it may be. And so you have this magnification of trading that goes on just off of the 1 ounce of silver, or for example, that's one issue. Then you have collateralization and financialization of the metals. You have people use it as money, or they use it as collateral or financing. It's something that you saw a lot of after COVID happened. A lot of metal came onto the exchange at the COMEX to take advantage of arbitrage and to use it as collateral because of the problems that you started to see with COVID was creating with logistics and so forth with London. It's one of the reasons why the metals industry is so large and so diverse, but it's also impacted so greatly by the trading side of the business. And that's where it's frustrating a lot of physical people, saying, at what point does the physical market actually take reign over the paper markets? And by design, it won't do that until, like you were mentioning, gold and silver start to go up in price in dollar terms as the dollar continues to strengthen against all these other crappy currencies. I mean, at some point it'll be valued as its own property, not necessarily in terms of, hey, listen, I can borrow it at X rate, or because you look at lease rates. Lease rates are going through the roof. This is creating demand for the physical metal off the exchange because people are it's becoming more expensive to deal with the metal. These are all impacts that ultimately deleverage that system and allow the physical to actually have more of an impact on a day-to-day basis. And that's what I've been seeing. I mean, that's the long-term approach to buying the physical metal. That's what Basel III is sort of signaling to me, is that the banks have been backing out of this market. You've seen Scotia walk away. You've seen a number of banks walk away from, or they've changed the trading desk from gold and silver trade on the commodities to now they moved it to the currency desk, or even to the equity desk. Because they now you have the authorized participants and the market making and all the issues that they deal with when they're dealing with SLV and the OTC products and the leasing and all the arrangements that which a lot of it is non-transparent as well. You don't really know what these authorized participants are doing with regard to SLV and their relationship. Are they, when they're delivering metal, and I'm one that believes that the metal's actually there, that the SLV wouldn't create the greatest fraud in history by not having the metal there. That's too easy. But it's the issue of where that metal came from, and is there any type of hypothecation that's tied to that metal? For example, in February of 2021, when you 30 some odd million ounces of silver come onto the market or into the SLV, and typically between 4 o'clock New York time and 9 o'clock London time the next morning, those bars have to be listed with bar numbers and so forth in a report and accounted for. Well, if you could tell me how 30 million ounces just came out of nowhere and all the bar numbers and the hallmarks and everything was documented, I would love to see it. No, but the case probably is that metal was sitting there in someone else's account, and that metal could have easily been leased to an authorized participant. Sort of authorized participant goes into the market, hedges the lease, but delivers the metal. I mean, there's a lot of games that are played.
But by the way, this is as Bob, what you're describing there. This is exactly why back during the 1800s, like if you look at like the gold rush in California and all the banks that were set up to take all these miners, all these guys who were mining gold and silver. I mean, how many of these banks went tits up throughout history because they were taking deposits of people's gold and silver, and they were rehypothecating it as to lend out to speculators, to business owners, to guys trying to do other things. And then all of a sudden, everybody comes in and wants their gold, and then the banker's like, "Oh, I don't have your gold. I have it lent out. I have it, 100 ways to Sunday." And by the way, what you just described is actually, I do believe that is going on, and there'll be a point in time, I think, where we'll have a coming to Jesus meeting, and there'll be a lot of people that are going to be caught with their pants down.
Well, the futures market, it's strange because people will say, okay, it's manipulation. But the futures market was designed as a hedger's market, designed as a seller's market. You look at the delivery process to take metal off the exchange. It's a seller that dictates the delivery of the metal, whether or not they want to give that metal up. That's what people need to understand, is just that's the way the system is. It's the structure of it. And the only way to correct that, or maybe have the physical market to have more of an impact, is you got to take the metal out of the system. So it can't use that leverage and give the power to the paper side. This backwardation that you're seeing in the market.
This is what I was going to say. This is exactly why you're seeing that backwardation in silver right now.
Yeah, well, and that's, you do have that demand for physical metal, but look at the swap dealers. These guys are now long on the futures market. Typically, when these guys are long on the futures, that's usually a sign that the market is bottoming. I mean, I should say it tends to appear when the market's bottoming. And then you have the managed money crowd that's shorting the piss out of the market because they're expecting, complete disaster in the commodities because of basically the reduction in the Fed's balance sheet, tightening of liquidity, yada, yada, yada. They have a very valid argument. And then you have this, like in the retail dealer community and in the industry, they've developed this borrow against your gold program, and a lot of dealers have jumped on this bandwagon the last couple of years to try and say, hey, listen, you don't need to sell your gold. You just need to borrow against it. That way you won't have any taxable event. And so you have people that are starting to get margin calls. And so you're seeing the leverage work in reverse. And then you have this idea of forced selling that's been pushing the market down, forcing people out of their positions. But that's where education needs to kind of come into play and teach people that, listen, if you're buying the metals, you don't need to go 10x leverage on silver. It's a volatile enough asset as it is. If you're going to do that, play some options with money you can afford to lose. But if you treat metals like private property, the current, that's why I keep saying the currency side is difficult for a lot of people to fathom. But if you could take metals or private property that you can actually take it with you, it's not reportable. For example, every single year, like paying taxes on your house or you're renewing your re-registering your car or anything like that. It's one of the few financial assets you don't have to go through this this hoopla of paperwork every year. Now, if you own assets in a foreign financial account, yes, you have Form 8938, you have the FBAR, but that's also manageable by actually store the metal overseas. I keep telling people the United States, even though I think the United States is still the safest place in the world to store metals. You look at the idea of customs fees, bringing gold, for example, into this country, the maximum custom fee you're going to pay, if you want to bring $1 billion of gold into this country, the maximum number you're going to pay, given that it's not Chinese metal because that's a 25% tariff, but it's going to be $528. That's it. And of course your shipping costs, but it doesn't cost an arm and a leg to move the stuff around like the crypto crowd wants you to believe. There's reasons, there's value that I see with the metals. Yes, it's not something you need to own 24 hours a day, 100% of the time. But in this type of instance, when you have an over-leveraged society and you have all this excess and so forth, and it hasn't been bled from the system yet, at some point when it does get bled from the system, there's going to be a lot of pissed off people that are going to have a lot of issues with confidence in the system. They're going to see everybody who's walked away, made a fortune, the politicians and everybody else, they're going to get mad and they're going to get angry. And you're going to see, the energy bills going up in Europe, all types of things ferment more and more distrust. And that's not something that I want to promote. It's just something that's happening. And that's where I can see the value of the metals.
And by the way, you're going to see that. You're going to see that when those spreads start to widen. They're not going to widen because it's a bad thing. They're going to widen because exactly what you just described. So when people start to see these spreads widening on the bid and ask on gold and silver, that's what you're looking for. That's what we're looking for.
Yeah, and the problem you have too, and I don't mean to get into the industry here, but there's a lot of frustration because bids and asks are a big deal with physical metals. It's again physical. The physical world is not regulated by the CFTC. It's led up to the states that oversee the physical world, and they just don't have the manpower to oversee it. So you see these online dealers, for example, that have these massive, they call it spot price, but it's their made up spot price. It's 20 cents, 30 cents in silver, for example, over the actual London spot price that the wholesalers key off of. And so there's this. You got to get away from the industry has to get away from profiteering mode and get to some type of consistency with pricing and allowing the client to say, I'm not buying a used car, take it off the lot, and I have no clue what that car is going to be worth. When I take it off the lot, when I want to trade it back in, that's the mindset a lot of people have, and they're losing the momentum of the physical buyer from an asset that I think has a lot of value right now. And that's what I'm trying to promote. I've talked to the industry at length to say, listen, maybe we should create a national exchange, other type of transparent system that you have a bid offer type of relationship where people can tighten those spreads up a little bit, but it allows people to see a more transparent market instead of this dealer market that is all over the map. I mean, the industry that would hit their pocketbooks, and I understand that. I mean, it's just the way the life is. But there's ways to invite the market or participants into this market without standing over their head with a 2x4.
That's a great way to put it, Bob. So, have you had any positive feedback, or anybody that wants to work with you on making a national type market?
It's difficult. I mean, I've talked to a few different tech guys. There's a lot of work that's involved. There's a lot of capital that's needed. A lot of liquidity that's going to need to be provided. The bottom line is to get the wholesalers and the way the industry is set up, it just chews into that bottom line. The industry needs disruption, and I think it can get very positive disruption. The problem is we went down this crypto route with some of these digital gold programs that are literally just balance sheet financing operations, or they're pool type of accounts, or you really are trading the price again. You have multiple counterparties, because when you do a lot of times you do a digital program, you throw in extra counterparties into that fray that, for example, sponsor of the metal may be also the one on the master agreement with the storage company. So that sponsor can literally use the metal, for example, for any whim that they have. If they want to lease that metal out, they have the authority to pull that metal from the facility. I mean, there's a multitude of different issues. what you need to do is create, if you're doing a digital program, you need to create a segregated product that's tied where the private address key or the token, whatever it may be, is tied to a specific bar in the vault. And so it trades more like a bond and not necessarily like a type of pool.
This is exactly what we've been talking about in some of these spaces over the last few months, Bob, right? I mean, we've discussed this, like the utilization of blockchain with the physical. The two at the crossroads. I mean, that would be a beautiful thing, right? Because you could do that with physical and with blockchain together.
Yeah, and then you could trade. You could, the token, so to speak, you could call it, is actually a commodity contract. If it's backed by physical metal, it therefore isn't regulated like a security or commodities future. Because it's actually it's a contract backed by the physical itself, so it can actually provide delivery of the metal within the 28-day period. But it seems like that would be too much of a disruption, but that's all it needs to happen. And then you could trade the contract as a token, so to speak, and the metal never leaves the facility, but yet the token could change hands 15 million times. But you have, again, the token holder actually would pay the storage fees. That's not some sponsor, because the sponsor doesn't, if the sponsor's paying the storage fees, they still have attachment to the metal somehow. The issue is depositories don't want to do that. It's too much work. And I know, because I run a depository, but yet I'm willing to do that type of thing because I see the need to have more simplicity in this metals market to get people more associated with the physical market. That's part of the allure that the metals could really bring, and the history of it and so forth. It just gets lost. And, the idea of, then you're trading the commodity contract and not necessarily, you don't have this wide bid offer spread. You don't have all these huge premiums involved. You actually can start to create more of a coherent two-way market like Bitcoin or the stocks. You buy it at whatever the price is, you sell it whatever the bid is, and you don't have this multitude of tier of discounts and premiums associated with that make it even more confusing for the person that owns the product. They're like, okay, what do I really sell this thing for? It's frustrating to watch, but and hopefully one day that could change, and maybe the markets will force that. But that's just one problem that I see in the marketplace to help people to get more interested in the physical metals. There's been studied 25% of your portfolio in physical gold and silver over a 50-year period of time is actually shown to actually reduce risk and actually enhance return in an efficient portfolio. So there are benefits to the metal outside of the end of the world. I hate the end of the world scenario because it sort of denigrates the need for the metal, because at the end of the day, most people buy the metal because not that they just want to try and protect themselves. They don't know what the market's gonna, or what the is going to hold. They just something that they know that they could trust. And human behavior and history of human behavior says at some point we trust the physical asset that's in our hand more than we trust, for example, the 2 ounces that are in the ground at a mining company.
Yeah, Bob, that sounds like a great project. It has some very interesting angles to it. What you might want to check is Digital Sugar. .io. Not that it's similar in any way as a commodity, but they've already done the same concept. Now, the only downside to their project, is that the company that's implemented the project is actually a large sugar company in the Middle East. I think they're based out of Dubai. So essentially, there's a bit of a conflict of interest. But if your project addresses that particular point, whereas it's an independent project, not affiliated to any one company, then I think it's a fascinating project and it might fly. If you want to check out the sugar example, it's digitalsugar.io.
Okay, appreciate it.
Is there anything else you wanted to touch on, Bob, that was maybe part of your presentation that you didn't get to?
Not to bore everyone to death about the markets. It's interesting. We talk about manipulation a lot, and I did a chart. I think it was the last 15 years of actual manipulation. I would say manipulation. I call it malfeasance, or it's the downside of the physical market. I think he paid a $900 million fine for to basically neither admit nor deny any wrongdoing, but there's been about $370 million of damages and corruption and theft and loss of property from just normal retail investors, of bullion dealers and people in the physical business. And that's something that's kind of overlooked a lot, because the industry needs to clean its image up as well. It's not just simply the pricing of the markets, but also there's a lot of players that prey on individuals, and it tends to put a black mark on the business. But when I was doing this sort of research, I mean, $370 million isn't chump change, and that's that actually has more damage than the spoofing that's done, by JP Morgan or some of the other ones, because that may influence the price for that moment. But when you're talking stealing from people's pocketbooks, that actually has a much bigger issue and outreach that needs to be corrected. That's something that I kind of brought up. In terms of, again, what I try to instill in people is to remember why you're buying in the first place, because obviously with the metal prices the way they're down right now, it's easy to get frustrated and to say, my God, this is the worst investment in the world. It has absolutely nothing to do with inflation. In fact, actually, to think that the dollar has been one of the best performing assets while we've had 40-year high inflation, it's just a kick in the nuts when it comes to the precious metals. But the metals market, I think, is not the few things that it's not really being priced in right now, and going forward is the political risk. It's the environment that all this disruption and tightening of the markets, the balance sheet of the Fed, so forth, and the volatility of the asset structure is going to start to bring in more disenchantment, and that's something that can start to fester. You see it in Europe and Asia and so forth. That's something that can really start to broaden, and that's something that the metals really shine on, is the dark side of people's confidence, and that's something that I think ultimately that'll turn the market up much more than inflation will.
One thing, Bob, that I thought was fantastic is the fact that it does feel like, for many people that are in gold and silver, during the highest inflation we were experiencing in the last 40 years in a generation, like a kick in the fucking nuts. And one of the things, if you take a look, and it's not this flight to safety right in the dollar. If you think about it, everybody, all the market participants globally, are of the belief that the Fed is going to keep raising rates, and furthermore, going to be shrinking their balance sheet. Right, this quantitative tightening everybody's been anticipating, the Fed has been talking about. If you believe, like I believe, that there is going to be no significant quantitative tightening, and we truly believe that, I think that they're a plus or minus 100 billion for the last few weeks. I mean, it's really been insignificant when you talk about a $9 trillion balance sheet. That's going to be the fly in the ointment. If the market starts to sniff out that the Fed is full of shit and that the Fed is going to go back to its old playbook, the minute we go into a mild recession, all bets are off. And I think that's going to be the moment where people believe that this whole fantastic adventure we've been on for the last dozen or so years with quantitative easing, 1, 2, 3, 4 now, and zero interest rate policy and just this Frankenstein market that the Fed has created. Once people start to lose faith in the Fed, that's going to be the switch. And I think and again, it's probably not going to be a process. We always talk about, okay, look, things are like a process, not an event. But in this case, this may actually be an event, not a process. It may literally be like a light switch. People just decide, you know what? The Fed has completely lost control here. We're going to get out while the getting's good. You know what I mean? So I think that it may in fact be on the horizon here, where it's not a process over time, but more of an event.
Well, one thing with the Fed, if the Fed actually wanted to, if everything started to hit the fan, they could actually dissuade money market funds, dealers, and so forth from this reverse repurchase program that's over $2 trillion. They could actually dissuade them from or reduce they could put into that fund or loan to the Fed overnight and force that money back into the markets or force into T-bills or whatever it may be. And that could actually have a dampening effect on interest rates or on the market side, near term. And that might be their game plan, is if they do have a wreck in the markets, they may start to go to that RRP fund or the fund that they created, but the program that they created.
I mean, you're looking at $2 trillion sitting there. So you're right. They could do that. And that's one of the reasons why we've seen what we've seen. But that could unwind very quickly. So you're right. If they decided to change direction, that's going to give you a signal. So I think that would be I would be tickled pink if that were to happen.
Yeah, because that'll push rates down, at least the short end of the curve down. But and in a way that would add liquidity sort of into the system, I guess you could say. But the problem that you have though is if the economy goes down, tax receipts go down, you're going to start to have these deficits. And of course, if you start seeing political disenchantment, you may see the political leaders say, listen, we need to throw out some more money to, let them eat cake, throw out some more stimulus packages and try and take their mind off things, keep the circus game going a little bit. But that's just going to increase the demand or the supply of treasury paper out there. So that's what I'm kind of focusing on. I mean, in the fund that I run, I've been short the bond market thinking this makes no sense because secularly, we have this longer term, been on a 40-year bull market, but now we have this excess or this secular, I guess, or this structural deficit issue that I don't think can be unwound unless obviously the economy just takes off, and they need inflation to reduce this deficit or have any way of servicing this debt. I mean, that's the oldest tool of the playbook. That's why I buy the metals, because at some point they can't allow the system to completely implode. Otherwise, you're going to have it's complete social chaos. I mean, you'll get it either way if they have hyperinflation, but that's it's easier to play the inflation game because they can keep kicking the can down the road.
Well, this is exactly what I tweeted about a month or two ago, which is like this pick your poison, right? You're going to have to pick your poison. Neither solution is going to be palatable, right? It's going to have some very distasteful downside effects, So, but that's where we are. I mean, there's really no easy solution, And I think we're closer to the Fed basically saying, look, we're going to raise that 2% ridiculous, silly mandate we've had for years. Now we're making it 3.5%, 4%. That's going to give them some breathing room. I think we're getting closer. We're starting to see a lot of talk around that. I tweeted this out months ago that I think the only solution for the Fed for everybody is really to come to grips with the realization that the inflation is going to run higher for longer. We're not going to have this 2%, sub 2% for many years, right? We've had under 2% inflation. I mean, labor costs are really the key here. I mean, the high energy prices, given with what's going on with the war in Ukraine, they could stay elevated for a long time. We may get a spike. I believe that's coming. We're starting to see it in Europe, of course. That's going to work its way around the globe. On the other side of this, we have the supply chain issues and the factories that have been shut down globally from COVID. We're dealing with COVID. We're dealing with the war. I mean, those two things are at some point going to get rectified. They're slowly, the COVID issues are slowly being worked out. The war, who knows? That may last a few more years. I have no idea how that's going to play out. But the reality is what's really the linchpin here is this the rise in labor costs, which is an effect basically of the other two, right? Because companies are now, companies are struggling. They're struggling to find workers, right? And so they're having to pay more. Employees now are demanding more. I mean, it's like, you know what? I need $20 an hour. I mean, just in California here, they're paying $18, $20 an hour at McDonald's. I mean, it's crazy, I mean, when I was a kid, not that long ago, right? Back in the kind of late, early 90s, I was making, $3.75 to $4.25 an hour as an employee at a fast food chain as a kid. Today, these kids are making 18 to 20 an hour.
Kind of interestingly, I did an interview earlier today, and to both of your point, O'Hare, and Bob's point there too, basically losing credibility or losing confidence in the Fed. Gareth was making the point that the bond market is kind of calling out the Fed because Powell came out as almost the most hawkish he's been, and yet the bond market didn't really react. Interest rates didn't really jump up. So he was saying that he thinks that they're going to start softening, and we're only going to get a 50 basis point rise in September.
That's right. And the market's sniffing out the coming recession. The Fed is orchestrating a recession, and therefore the market's sniffing that out. And they know that the next move for the Fed in this chess game is not much higher rates. It's probably going to be much lower rates. It's going to be more QE, not QT. I mean, they're going to have to go back to their own playbook. I mean, this is a monster they've created, and now it's a tough job. I mean, I don't envy the Fed. I don't envy Powell, but they put all of us in this predicament. I mean, it's really their fault. They could have done things a little differently through the pandemic, right? They could have done things differently going into the pandemic the years before, but they chose not to. 2018 was an opportunity for them to continue on with delicate rate increases. They could have done 25 bips for the whole entire year. They didn't. The market dropped 20% in a matter of 2 weeks at the end of 2018. And what do? They did about face and started doing QE again. I mean, again, that playbook is on his desk. There's no doubt in my mind. So if anybody thinks differently, I think you're crazy. I think the Fed is going to go back to that playbook. In fact, it may be on his lap as we speak.
Well said, O'Hare. Guys, are going to wrap this up. Unfortunately, we've been on here for 4 hours now, so I think this is a pretty good spaces. We'll do more in the future for sure. I really appreciate everybody tuning in, everybody's input, and hopefully everybody, maybe even if you didn't learn something today, you had something to think about. I appreciate everybody's time, and we'll see you on the next one.
Palisades, you need to do more of these. Fantastic. I'd love to hear Bob and all these guys that were in here. Great space. So love to have all you guys. And Bob, you should run a couple more of yours. I know you were running some spaces over the summer. I think you should continue doing that. I think to educate more people on this subject, because I think there's a lot of people that are looking, that are thirsty for information, and we just don't have enough of these spaces.
Yeah,
and
definitely.
You guys do a great job.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.